I am. Thank you, Scott. And thank you, Jim, joining us from the MFA event in Miami today. An important day to have you here and get your perspective. I'm curious just to kind of kick things off. Obviously, the market declining at a voracious pace here. Do you believe this to be short-term capitulation, or do you think there's a deeper decline in store for us here?
Well, thanks for having me, Leslie and Scott. I have obviously no idea. The excesses we've seen in 2020 and 2021 are in the process of being wrung out, and I don't know that you've been talking about the Fed for the last, I guess, half hour, and what it might do, but I would just point out that the Fed, as Steve Leisman said, is concerned about the real economy and may not be as concerned about the stock market. We had a Fed that was easing throughout 07 and 08. We had a Fed that probably more important for this discussion was easing from the second half of 2000 into 02, 03. And yet the S&P went down 40% and NASDAQ went down 80% after the dot-com blow-up. The economy had a mild slowdown. That was it. So there's no preordained route here connecting necessarily Fed policy with how you're doing, in your mutual funds. They may diverge, they may not. At my firm, we're comfortable being long the indices and being short, a lot of kind of the craziness. I think that's still going to be kind of the way you want to be. I think you want to avoid a lot of the stuff that's still trading. I mentioned earlier this morning at 50 times 2022 or 2023 earnings. There's a lot of those, and they're not necessarily in tech stocks. There's a lot of sort of mundane businesses that have, after 10, 12 years of a bull market, are trading at just really, really expensive levels for what they are. And I think you got to go through your portfolio and just sort of say what really is cheap and what's necessarily just down. They might not be the same thing.
So what are you doing with your portfolio today? Are you covering any shorts on these declines? Are you adding to certain short positions? How are you trading today's market action?
Well, as you see, I'm not in front of a screen. I've been at the MFA conference this morning, but my traders, we have price targets, and if something is hitting our price targets, we would be covering it on the short side. We'd be adjusting our hedges. I think we've been slightly net long for most of 2022, about 10% net long, but that's sort of 70% short, 60% long. So we run, in our hedge fund, as Scott knows, just a more traditional hedged book. And that was very, very painful in 2020 and early 2021. But it's been a lot less painful, obviously, since mid-year last year, as a lot of sort of craziness has begun to be wrung out of this market. I would note also we're at the one-year anniversary of the meme stock craziness. And those have round-tripped, which is sort of the unspoken part of the whole meme stock saga, is just how much the wrong lessons were learned from that. A lot of hedge funds that are in this room, basically shied away from idiosyncratic shorts and just hedged their exposure using indices. And I think actually the meme stock insanity of the first half of 2021 was kind of the top in those types of stories. And those are the kinds of companies that have been under pressure since really the summer of last year.